Favorite traders, welcome out to Stock Takeovers. Now, as the name suggests, a takeover is something where I'm going to take it. I'm not agreeing. This might be a hostile situation, but a takeover is something where a lot of times they're going around the CEO, the CFO, the COO. They're trying to basically take over the business and do it through the stock market. And there's a couple of different ways that they can do that. The two main types of takeovers are, well, there could be a friendly or there could be a hostile takeover. Now, let's think about how this works and how it differs from the private markets. A privately owned business, if I start a business, I pretty much own 100%, right? Now, maybe I've given partial ownership to other people, but if I own over 50% at least, I have a controlling stake. And I am the decision maker, and nobody can come take this business away from me because I own it, I control it. But once you go public and you go IPO, you're now a publicly traded company. Usually there's more, you don't own over 50%. Now, there are some exceptions to that, but for the most part, investors give up most of their stake. Now, they might still own a lot. Take Mark Zuckerberg, who started Facebook. He still owns a large portion of Facebook, now known as Meta, right? They changed their name, changed their stock symbol. He now owns a lot, but he doesn't own over 50%. However, he owns so much of it, and he has so many people that will back him, and importantly, he's a Delaware corporation. Now, the reason that businesses register in Delaware is because it really gives them a lot of control, and it takes a lot of control away from these possibilities. And so you'll hear the term that there is an activist investor. Who are some activist investors? Well, a person like, there's quite a few of them, but Bill Ackman is an activist investor. Carl Icahn is an activist investor. An activist means essentially that a lot of times they'll be actively involved in their investments, and they will try to get people that work for them to become members of the board, right? To get on the board of directors, to start to have some push and some pull. They might really push the business to do certain things. They might try to get rid of a CEO. They're active, as opposed to someone like Warren Buffett, who's more of a passive investor. Even though he's so large and so respected, he doesn't get into these battles and things. When he takes over a company, it's not a takeover, it's a merger. He comes to an agreement. If they're not willing to agree, he doesn't go to the shareholders and put up a big fight or anything like that. So these are a little different than just a nice merger. There is a certain takeover aspect to it. Now, a friendly takeover means that there's some sort of agreement, some sort of merger that takes place. This would be, a company successfully closes on a bid to acquire the other company. Takeovers are generally a large corporation taking over a smaller one. And if it's a welcome takeover, then basically they've come to some agreement. At least the shareholders have. Now, maybe in this case, they've bypassed the CEO, or maybe they've gotten the CEO ousted. The shareholders agree, and so this large corporation pays $80 per share. The stock used to trade at 60, and so that's a nice premium to where it was before this company came in. And the shareholders say, hey, I like 80. I think that's good. The shareholders vote. They agree to the takeover. The CEO is ousted, so on, and he kind of loses the fight, and the company is acquired. A hostile takeover would be, that's sort of, I guess I kind of described a more hostile situation, because if you're throwing out the CEO and going directly to the shareholders, that's sort of hostile. There would be a little bit more friendliness maybe to this one, where there's some battling taking place, but they ultimately agree. That's kind of what I want to get to, is a friendly takeover might have started a little ugly, but at some point they kind of come to some agreement. A hostile takeover is really trying to take control and doing a lot of things. Now, that means that one party is really aggressive, and they're going to try to do certain things where, again, they're going to try to take control of this business and go directly to the shareholders and say, here's how bad the CEO has been, here's how many mistakes they've made. Now, the corporation, because they're registered in Delaware, the vast majority of them are for this reason. It's just really hard to take over a business if they don't want to be taken over, because they can do things like a poison pill. And what a poison pill is basically the company that's supposed to be acquired can issue shares at a discount to current prices to existing shareholders, not the potential acquirer, but to others. And so basically kind of a discount to themselves, essentially. So they print more shares and they, the company, buy those shares at a discounted price. And what does that do? It dilutes the shares and it also increases the current owner's stake. It gives them more shares, more voting rights, and so forth. And it also makes it harder for this company to acquire because now they got to pay all these shares at this higher price and they've been issuing them to themselves. It's just kind of a weird dynamic where if you take on a poison pill, for the most part, you kill any deal that's possible. And so that's a situation where, again, because they're a Delaware corporation, they can do certain things to not be taken over. And again, it's pretty hard for a lot of these takeovers to really go through if the company doesn't want to agree or the shareholders relent. You've seen some huge examples where corporations have battled it out. I remember one that I was a little bit involved in years and years ago. Um, there was ConAgra, and they were buying out, I'm trying to remember the company's name, but anyway, this was quite a few years ago, and they were going to buy out this corporation, and there was kind of a fight over this, and ConAgra offered a higher price at like, $100 a share when the stock is at like 70 or something, and the corporation did not agree, and so the stock kept trading. And remember that usually in these circumstances, the stock down here can be volatile because when they find out that a company's trying to acquire, usually it'll gap up. But then when they find out that this company's not wanting to be acquired, it can like fall back down and so on. And it can be a volatile dynamic. Well, fast forward, and this company ended up spinning off one of their businesses. So they kind of broke into two parts. This spinoff was a smaller division, and then they agreed to be bought out. So it was like, hey, you don't get this piece of the company, but you can have the rest of it for up here near this price and so on. And so ultimately a deal went through, but not for the entire business. This little portion of the business went on to be its own entity and to trade on its own. And that's what a spinoff is. A spinoff is basically, say you have a huge corporation, and let's take a company like GE, which is going to go through a spinoff. GE has a financial services arm. They have engines and kind of an industrial where they actually make the engines that go in Boeing planes in many cases. They have an energy division, oil services, and so on. So they have different entities within General Electric, right? And in a spinoff, they might break these apart. They might say, okay, this company is going to go on its own, this company is going to go on its own, and this company, and they're going to break into three parts. And basically, based on what they think the total value of the company is, let's say that the company is worth 100 billion prior to the spinoff, they might say, well, the financial services is only worth 20 billion, the engines is worth 40, and maybe the energies were 40 or something like that. And so they would break them up according to the size. And they would go on to trade and be their own businesses. And they would no longer be part of the GE business. So sometimes, spin-offs and things like that can take place. But in this takeover situation, what we want to look at is how the stock will behave. So when you think about companies and acquisitions, I'm going to go through the most common dynamic. When the news hits that company A, which is big, is trying to buy company B, which is smaller, Here's the typical dynamic. Stock of company A, the acquirer, right? Let's call them the buyer. The buyer of the smaller company, usually their stock price goes down. The stock price generally goes down because people say, well, that they're paying an expensive price. I'm not sure we liked it. Whatever the reason, usually the acquirer goes down in price. The company being acquired, okay, the seller of the business, usually their stock price goes up. Why? Because here's where the stock is trading in the current market. Let's say that it's trading at $50 per share. That's what it's currently worth. Nobody's going to sell to company A for 50 because they're going to say, well, no, we're happy with the business as it is. If you want to acquire, you have to buy at a premium, almost always. And so this company has to come in and say, well, we'll pay, $73 per share. We'll pay a $23 increase to current prices. So their stock drops a bit, and usually this stock jumps on the news, right? But how much does it jump? Well, it won't go straight to 73. Why not? Because there's still a lot of risk. This deal could fall apart. So in a takeover, in some sort of merger, this stock will gap up, no doubt, but it'll usually trade at a discount to the deal price. This deal price might not close for a year, and you don't want to pay 73 or even close to 73 if you're only going to get 73 back, and you have to sit on the shares for a year. So who wants to pay, $72 per share to be able to get 73 for it a year later? No, thank you. I don't want to make $1 per share and have to sit on this stock for a long time with a ton of risk that the deal falls apart anyway, So usually this stock will gap up, but it'll gap up well below the deal price. Now, the closer it is to the deal price, that's informational. The closer it is to the deal price, the more confident the market is that the deal is going to go through and so forth, right? If it's further away, there's less confidence. If the deal is being negotiated and talked about and so on, or even agreed to at 73 and the stock only goes to 55, you'd have to say, well, who knows what? Why do they think this is not going to go through? Right now, there's a deal in place for Activision from Microsoft. The deal is talked about or agreed to at 95, and I think Activision right now is trading around 75. So that right there tells you that if Activision is trading at 75 and it's supposed to be, the deal is supposed to be completed and both companies have agreed that Microsoft will buy all shares at 95, that's a $20 premium. That's quite a bit of money. Somebody thinks, less confident, somebody thinks this deal's not going to go through. Whether the regulators are going to shut it down, whether a company's going to back out, whatever it is, it's unlikely to go through. What if the stock is trading close to 73? First of all, that would be confusing, wouldn't it? You'd say, well, who in their right mind is buying the stock at 73 when the deal's going to go through at 73? These idiots, what are they thinking? Well, I'll tell you, the market's not just completely dumb. If this stock gaps up and it's trading really close to this price, or sometimes even above it, what does that tell you? That tells you that there's another bidder. There's somebody else out there, that's looming, and the market is very comfortable that this other buyer is going to start getting in on this and start trying to acquire that same business. Recent years, I remember having a position in Anadarko Petroleum, which was symbol APC. They agreed to be bought out by Chevron. The stock gapped up in Anadarko because they were being bought at a premium by Chevron. The stock went up a lot, pretty close to the deal price, and that's confusing. Your first reaction is, wow, why is it trading all the way up there? And sure enough, the market was smart and the market was right. And Occidental Petroleum said, hey, no. Don't sell to Chevron. We want to buy you. And we'll pay more than Chevron. And all of a sudden, there's a bidding war. And the deal was ultimately struck at an even higher price. So Anadarko reneged and said, no, we will not sell to you, Chevron, as agreed to. Occidental has agreed to pay even more. They did have to pay a breakup fee, but actually Oxy covered the breakup fee. So Oxy paid Chevron $1 billion for the breakup fee and then acquired Anadarko at an even higher price. And so the shareholders of this company got even more than the original deal price. Now, that's pretty much how you trade these. Is what you'll find if the deal is really good and it's close to its closing, the stock price will gap up towards the deal price and then it will flatline. If you ever see a stock chart that is just perfectly flatlining for a few weeks, you know that it is a company being bought. And it's pretty close to its buyout price. So if you see that stock chart, the huge gap up and then perfect flat line, it's hard. I don't trade it. That tells you the deal's going to close and it's pretty close to the buyout price. There's just not really a lot of money. If the stock gaps up, but now it starts to trade, huge gap up, and there's a potential merger and so on, then you have the chance to trade arbitrage. And what arbitrage is basically, trying to take advantage of the difference between where it's trading and where the deal is supposed to be struck. Now let's look at a couple of examples of this. Here's a chart of Activision, which we talked about. And if you were to look at the data, in fact, we go to Google, Activision, buyout, Microsoft, it'll tell you some details and it'll say, okay, we need to know some information, by the way. But Activision shareholders are in line to get $95 per share. When the deal closes, you'd have to try to find out when it's expected to close. And this is still, probably months and months away. They have to get approval from regulators because regulators make sure that there's not a monopoly situation, that there's not too much control over an industry. If one company has too much control, then they can jack up prices to consumers and so on. So here's Activision trading at 90 or at 76, but it's supposed to be sold for 95, which is off the chart. I got to go back a few years. And so there is an arbitrage situation here, right? You could get paid 95 and if the deal closes, it depends on your confidence. If the deal closes at 95, every share is going to be sold for 95 and I can buy it today at 76. The difference between those is a profit of $19. That is a gain of about 25%. So it's trading at a 25% discount to the agreed upon price. And remember, both corporations have agreed to this. So the market's telling you, hey, there's some risk to this deal, that it may fall apart. You see how when the deal was announced, there was the big gap up, but even then it was trading well below the deal price and it has drifted lower since then. So less confidence in the market that this deal is going to go through. Now, there was a company just this week that was announced to be bought out. It was Horizon Therapeutics. And let's see if we can find that. I think that's probably it, okay? So look at Horizon Therapeutics and look at some of the happenings here. First of all, maybe somebody caught wind of this ahead of time because you see how the stock gapped up and then some volatility. And now it's gapped up even further. So Amgen agrees to acquire Horizon Therapeutics. The company will pay $116 for each Horizon share. Now, this is important. Sometimes companies will pay in their own stock. Sometimes they'll pay with cash. If it's with cash, it's easier to analyze. So you're going to get $116.50. This deal is probably going to close pretty soon because look at the market's very, very confident. It's trading at 113. The deal is agreed to at 116.50. So it's just shy of that. There's really no profit potential in buying here. You can only make $3.50 per share. And, there's a lot of risk if the deal were to fall apart, not much reward unless there's another buyer. If a bigger, some other huge biotech came in and started trying to get in on this and offering an even higher price, then things could go crazy to the upside. But here I don't think that's the case. And I'll bet this stock chart, if you were to watch it in the coming days, will just start to flatline up here. And it will drift slowly up towards that 116.50 per share deal price and be right at about that price the day of the closing. So this is a deal that I think is going to go through. Now, there was some opportunity back here when it first gapped up, and I don't know if this was a rumor or what was happening. This is something that happens in the markets that theoretically should be illegal. The stock should not jump before the news is announced like that. Who knew what, when, where, how, why? That's insider information. If you work for Horizon and you catch wind that you're in negotiation and then you go buy the stock, you're trading on insider information. That's illegal. You're going to go to jail like Martha Stewart and so on. But people do it. Sometimes the news leaks and so forth. And that's the unfortunate nature of the markets. But there you can kind of see how these things play out, right? This deal, the market is very confident that it's going to go through, and my guess is that the closing is not too far off. Maybe this deal will close within a few weeks or something along those lines. So as you think about this, these mergers and acquisitions and takeovers and so on, it gets a little messy. If you feel confident that the deal is going to be struck, you could try to arbitrage to the upside. If the deal is likely to fall apart, you could try to position for the downside. They're hard to trade because the liquidity is not great. So a lot of traders simply say there's just a lot of other ways to make money, and I'm not super interested in messing with these options because the bid-ask spreads will be really wide and it's difficult. You've got to be super careful on your executions, using limit orders, trying not to trade illiquid stocks at illiquid times and so forth, trying to get, if you're going to do it, try to stick with the Activisions of the world that at least have a lot of volume and things of that sort. One final example, VMware is being bought out by AVGO, which is Broadcom. Now this one's kind of interesting because it is a $61 billion deal, but it's a cash and stock transaction. And so what that means is that VMware shareholders are going to receive some cash and some shares of AVGO. So here's what happens when this type of deal takes place. In your mind, sort of memorize this stock chart in your mind. Downward trend into October. Upward trend since then with a recent peak. You see that? You kind of memorize that stock chart. Now look at VMware's chart. Downtrend into October, uptrend since then, peak just a couple of days ago. It's pretty much identical. VMware is tracking Broadcom because mostly they're paying in Broadcom shares. So if you're a VMware shareholder, you're going to receive the shares accordingly. If the stock price goes up, VMware, the deal is priced better. If Broadcom stock price goes down, the deal is kind of not, going to track the same way. So it's kind of following that movement, essentially. If they agree to pay X amount of stock and X amount of shares, and they say, well, you'll get, for every deal, you'll get, let's just say, one share of VMware becomes one share of Broadcom. If that's the way the deal is struck, well, the higher the stock price goes, the more valuable the deal is to VMware. The lower it goes, the less valuable, right? Because we're just going to receive X amount of shares as the deal is struck. So you can see that VMware and this deal price went down while stocks were going down, and it tracked Broadcom almost exactly to the day. And when Broadcom made the big reversal higher, so did VMware, right? This is sort of, VMware is now tracking this stock. And so as this stock has run higher, the deal was going to go for more value to the VMware shareholders. So that one's kind of a tricky one. Another example of a takeover, a merger type of dynamic, and the stock price trading around. If Broadcom stock is going to go sharply lower, this deal, this stock will go lower because the deal is not worth as much to these shareholders. If Broadcom goes sharply higher, even better deal for these shareholders accordingly. So it's kind of tracking Broadcom step for step because it's mostly a stock deal. It's not in cash. If it's in cash, this stock will track towards the buyout price. If it's in stock, the company that is being acquired will track and follow the acquirer stock accordingly. So we'll leave it there. Those are some good things to understand and know about takeovers, whether they be friendly or hostile. Hope you've enjoyed this class. Have a great rest of your day, and we will see you next time. Goodbye, everyone.